All right, let's take a deep dive into a topic that's creating some buzz in the financial independence community. We're talking about small cap value stocks. Are they really the secret sauce to superior returns or just a risky distraction? We're going to analyze a blog post from Early Retirement, now published on December 2nd, 2024, to see what we can uncover. Small cap value stocks, you often hear people just shorten it to SCV. They have a long history of strong performance, from like 1926 to the early 2000s. A small cap value fund would have significantly outperformed the S&P 500. This historical success has led to investment strategies like the four-fund portfolio. Have you heard about this one? It was championed by financial expert Paul Merriman. So like the four-fund portfolio allocates 25% each to the S&P 500, large cap value, small cap blend, and then small cap value. Merriman's claim is that this approach leads to superior returns compared to just investing in the S&P 500. And his data from 1928 to 2021 seem to support that claim. But our blog post author argues that if you look a little closer, you might see a different story.
Since the late 1990s, the four-fund portfolio has consistently underperformed compared to the S&P 500. This raises concerns about whether that past success is a reliable indicator for the future. So to address this, the author dug into the statistical significance of the four-fund portfolio's purported outperformance using those rolling 10-year and backward expanding time windows. And they concluded that the evidence for significant and consistent outperformance is pretty weak. And it's worth noting that this analysis is based on specific timeframes and methodologies. So the author's choices in these areas could definitely influence the results. Now, proponents of the four-fund portfolio, including Merriman, often highlight its diversification benefits. But the blog post kind of challenges this idea, arguing that adding SCV to a portfolio that already includes a total market index fund might actually decrease diversification and increase volatility. So it might seem counterintuitive at first. Why would adding more assets to your portfolio make it riskier? But to understand this, you have to think about correlation. It's kind of like thinking about two people walking. If they're walking in the same direction, they're highly correlated. But if one zigzags while the other one walks straight, their movements are less correlated, right? Now, in investing, correlation measures how closely the prices of two assets move together. So a correlation of one means they move perfectly in sync. A correlation of -1 means they move in opposite directions. Most assets fall somewhere in between, obviously. And the blog post author argues that just because you add an asset with a correlation below 1 to your portfolio, that doesn't automatically guarantee reduced volatility. And they actually use a formula to demonstrate this point, showing how adding an asset can actually increase volatility, even if it has a correlation below 1 if the asset's own volatility is high enough. And they actually apply this formula to the ETFs that make up the four-fund portfolio, using data from 2014 to 2024. They found that while the large cap value ETF IWD would have slightly reduced volatility because of its low correlation with the S&P 500, the other ETFs, including the small cap value ETF IWN, would have actually increased volatility. And this pattern holds true over different time horizons, including the period since the ETF's inception in 2000. And even when they extended the analysis back to a simulated period starting in 1926. So the blog post highlights an important takeaway. Diversification isn't as simple as just adding more assets. You really need to carefully consider the correlations between assets and their potential impact on volatility. Even a total market index fund, which is often considered very well diversified, wouldn't necessarily reduce volatility if you added it to a portfolio that already has the S&P 500, because that high correlation could offset the benefits of diversification, especially when the market is changing quickly. The blog post ultimately recommends just sticking with a broadly diversified equity index fund, such as a total market fund or a large cap fund, instead of chasing that allure of SCV. While they acknowledge that SCV might have a resurgence, the author emphasizes its recent underperformance and the questionable benefits. The author also looks at whether investors making regular contributions would have benefited from the four-fund portfolio. And according to the post, the point where an investor with regular monthly contributions would have actually done better with the four-fund portfolio compared to the S&P 500 was March 1977. To double their portfolio compared to investing just in the S&P 500, an investor would have needed to start making those regular contributions all the way back in 1943. Even with diligent monthly investing since 1926, the portfolio would only be roughly 3 times the size of that simple S&P 500 portfolio. These findings kind of contradict those claims that adding SCV can quadruple your portfolio. And this discrepancy between the buy and hold investors and regular contributors is attributed to sequence risk. So basically, early outperformance benefits you less when your portfolio is small, and later underperformance hurts more when your portfolio is large. And the blog post suggests that many SCV investors would experience this pattern. They missed out on the big gains during those early decades of SCV's strong performance because their portfolios were still small. And then when their portfolios grew substantially, they were hit by the recent underperformance of SCV
compared to the S&P 500. So this brings us to the central question. Has the four-fund portfolio, with its heavy reliance on SCV, lived up to the hype? Based on this analysis, the blog post argues that it hasn't, at least not in recent decades. Yeah, the blog post argues that those incremental performance gains from the four-fund portfolio have been, well, inconsistent. And the diversification benefits, questionable, right? That potential for outsized returns, maybe it's more like a historical anomaly than a reliable strategy going forward. Which raises an interesting point about Paul Merriman himself, right? He's a respected financial expert and a strong advocate for the four-fund portfolio. But even Merriman has admitted that the four-fund portfolio can be more volatile than the S&P 500. And the blog post actually includes a screenshot from Merriman's own website, showing the four-fund portfolio with a significantly higher standard deviation than the S&P 500, meaning bigger price swings, which can be unsettling for investors, especially those closer to or already in retirement. But here's the thing. Merriman contradicted himself in a recent podcast appearance on Afford Anything. He claimed the four-fund portfolio actually has lower volatility. So this inconsistency, it kind of raises some red flags, doesn't it? It really underscores the importance of carefully examining any claims made about SCV and the four-fund portfolio. Now, the blog post author goes as far as to say the four-fund portfolio has been a form of diversification, and not just from a returns perspective, but from a risk management perspective too. Adding SCV to a portfolio that already has a total market index fund hasn't delivered on those promised diversification benefits. Instead, it's often led to increased volatility, potentially making investors' portfolios worse off over the past few decades. Now, it's important to remember, no one can predict the future of the market with certainty. Small-cap value stocks could definitely stage a comeback. The blog post acknowledges that. But they caution against betting on it. That recent underperformance of SCV has been significant. There's just no guarantee it'll reverse course anytime soon. And even if it does rebound, trying to time the market to capture those gains is a tricky game. Often leads to more losses than gains. The author always talks about the current market environment. All the hype around AI, it's driven up valuations of many large-cap growth stocks. So it's possible that this AI-fueled bubble could burst. And if it does, that could lead to a shift in market leadership back towards value stocks. But trying to predict those market shifts, super challenging. So where does that leave us? Well, the blog post recommends a simple, straightforward approach. Stick with broadly diversified equity index funds. They suggest either a total market fund or a large cap fund. A total market fund that captures the entire stock market. Large cap fund focuses on the largest and most established companies. These funds offer broad diversification, low costs, and a proven track record of long-term growth. Relatively easy to manage, requiring minimal effort and expertise. But some investors might find that advice, well, boring, right? The allure of a secret sauce strategy like the four-fund portfolio can be tempting, especially when it's presented with compelling historical data and those enthusiastic endorsements. But as this blog post shows us, it's crucial to look beyond the surface. We got to critically evaluate the evidence, especially when it comes to these complex financial strategies. Sometimes the simplest approach is the most effective. And when it comes to investing, that often means sticking with those broadly diversified, low-cost index funds. Now, this deep dive provides one analysis of the SCV landscape. But the world of investing is vast and complex. There are always multiple viewpoints to consider. Before making any investment decisions, it's crucial to do your own thorough research. Seek advice from qualified financial professionals who can tailor recommendations to your specific circumstances and goals.